The global financial landscape is once again fraught with tension. On September 14, 2025, speculation is rampant after a dramatic escalation in the U.S.-China trade war. Earlier this year, the Trump administration hiked tariffs on Chinese goods to 145%, prompting Beijing to retaliate with 125% tariffs on U.S. imports. This tit-for-tat has sparked fears of a new economic Cold War, and revived talk of China weaponizing its U.S. Treasury holdings. The idea, if China dumps its vast U.S. bond holdings, it could destabilize the American economy. But is this threat real or overblown? In this video, we'll break down the reality behind the headlines and explore the true risks to U.S. financial stability. For decades, China stood as America's largest foreign creditor, playing a pivotal role in the global financial system. The relationship between the world's two largest economies was deeply intertwined, with China's economic rise fueled in part by its vast holdings of U.S. government debt. China used its massive U.S. dollar surpluses, earned from years of exporting goods to America and the world, to buy U.S. treasuries. This not only helped stabilize the value of the Chinese yuan, but also provided the U.S. government with a reliable source of funding for its deficits. The arrangement was mutually beneficial. U.S. consumers enjoyed affordable imports, while China's export-driven economy boomed. At the same time, the steady flow of Chinese capital into U.S. treasuries helped keep American interest rates low and supported government spending. But as of early 2025, the landscape has shifted. China is now the second largest holder of U.S. treasuries with $759 billion, down sharply from its peak of over $1.3 trillion just a decade ago. This marks a significant change in the balance of global finance. The reduction in China's holdings has been gradual and deliberate, not a sudden sell-off. It reflects a strategic decision by Chinese policymakers to reduce exposure to U.S. debt, manage risk, and diversify the country's foreign reserves into other assets and currencies. Japan has now overtaken China, holding more than $1 trillion in U.S. government debt. This shift underscores the changing dynamics among America's top creditors and highlights Japan's ongoing role as a financial powerhouse. Meanwhile, a wide array of other nations, as well as private investors and global institutions, collectively own trillions more in U.S. treasuries. The ownership of U.S. debt is now more widely distributed than ever before. This diversification means the U.S. Treasury market is less dependent on any single country, especially China, than it was a decade ago. The risks of over-reliance on one major creditor have diminished, making the system more resilient. Of course, a major move by Beijing, such as a rapid sell-off, would still send shockwaves through global markets. But the U.S. is no longer as vulnerable to a single country's decisions as it once was. The era of China as the indispensable U.S. creditor is fading, ushering in a new chapter of global finance where power and influence are more widely shared. Rumors swirl that China could sell 44% of its U.S. Treasury holdings, over $330 billion, in a single blow. Such a move would crash bond prices and spike U.S. interest rates. But there's no evidence Beijing is planning this. Recent data shows only slow, incremental reductions, not a massive liquidation. Experts agree, a fire sale would hurt China most, devaluing its remaining assets and strengthening the yuan, which would cripple its export sector. Selling treasuries means selling dollars, causing the yuan to appreciate and making Chinese goods less competitive. For China, this would be economic self-sabotage. The threat of a sudden dump is more myth than reality. Beijing's strategy is caution, not chaos. The U.S. Treasury market's April 2025 turmoil was dramatic, but the real story is more complex than Chinese retaliation. While the headlines focused on Beijing, the underlying factors were far more intricate and global in nature. Yields spiked, but analysis shows much of the sell-off was driven by hedge funds unwinding risky trades, not a coordinated move by Beijing. These hedge funds, facing margin calls and liquidity issues, had no choice but to liquidate their positions, exacerbating the market turmoil. Other major holders, like Japan and the UK, sold even more treasuries than China during this period. Their actions were driven by their own economic strategies and needs, not by any geopolitical maneuvering. Japanese insurers and European pension funds are shifting to higher-yielding markets, reducing their U.S. exposure. This shift is part of a broader trend where investors seek better returns in a low-interest rate environment. Bond vigilantes, investors protesting U.S. fiscal policy, also contributed to the selling pressure. These investors are wary of the U.S. government's fiscal policies and are pushing back by selling off treasuries. The result, a perfect storm of market forces, not a single hostile act. It was a confluence of various factors, including economic policies, market dynamics, and investor sentiment, all coming together to create the turmoil. The Treasury market's vulnerability is now shaped by a global chorus of sellers, not just China. This interconnectedness means that actions in one part of the world can have ripple effects across the globe. The April panic was a warning about broader market fragility. It highlighted the need for better risk management and more robust financial systems to withstand such shocks. The narrative of a Chinese nuclear option doesn't fit the facts. Instead, the events of April 2025 underscore the complexity and interconnectedness of global financial markets. The idea of China weaponizing its treasury holdings ignores the deep economic ties binding both nations. A rapid sell-off would spike the yuan, devastate Chinese exports, and destabilize its own economy. The U.S. Treasury market is uniquely large and liquid. No other market can absorb China's reserves without chaos. Even if China wanted to diversify, alternatives like Japanese or German bonds are too small to handle such flows. This reality keeps China anchored to the dollar system, at least for now. The U.S., meanwhile, can counteract market shocks with tools like quantitative easing. Both sides are locked in mutual dependence. China needs U.S. markets and the U.S. needs China's capital. This interdependence is the real deterrent against financial warfare. Most market experts dismiss the idea of a Chinese treasury dump as self-defeating. The consensus among economists and financial strategists is clear. Such a move would inflict more harm on China than on the United States. Not only would it devalue China's own vast holdings of U.S. treasuries, but it would also send shockwaves through global markets, potentially destabilizing the very system that supports China's export-driven economy. A massive sell-off would hurt China's own wealth and exports, making it a non-starter for Beijing. The ripple effects could undermine the value of the yuan, disrupt trade relationships, and threaten the stability of China's financial system. For a country so deeply integrated into the global economy, the risks far outweigh any potential leverage. U.S. officials, including Treasury Secretary Scott Bessent, have downplayed the threat and expressed confidence in the government's ability to manage disruptions. They point to the depth and resilience of U.S. financial markets, emphasizing that the U.S. dollar remains the world's reserve currency, trusted by investors worldwide. Yet beneath the surface, a quieter concern is growing. The real issue isn't a dramatic sell-off, but a gradual shift in sentiment. Foreign demand for U.S. treasuries is declining as investors grow wary of U.S. policy volatility, fiscal uncertainty, and rising geopolitical tensions. Official foreign ownership has dropped from 48% in 2019 to 39% in 2025. This steady decline signals a loss of confidence among international investors, who once viewed U.S. debt as the ultimate safe haven. The U.S. is increasingly reliant on private investors, who are more sensitive to market swings and demand higher returns. Unlike foreign central banks, these investors can quickly shift their portfolios in response to changing market conditions, adding a new layer of unpredictability. This shift raises long-term borrowing costs and market vulnerability. As the government pays more to attract buyers, the national debt burden grows, and the risk of financial instability increases. The true risk isn't a sudden attack, but a slow erosion of trust in U.S. financial stewardship. Over time, this could undermine America's economic leadership and global influence. The challenge is maintaining confidence, not just defending against a hypothetical sell-off. In a world where perception shapes reality, the U.S. must work to reassure investors and uphold its reputation as a safe and stable destination for global capital. The fear of a catastrophic Chinese sell-off is more fiction than fact. Economic logic and mutual dependence make such a move highly unlikely. The April 2025 turmoil was a product of many forces, not a single hostile act. China's gradual diversification is a long-term strategy, not an act of war. The real threat is a slow decline in global confidence, driven by U.S. policy unpredictability. Restoring trust and stability is the key to safeguarding America's financial future. In a world of uncertainty, trust, not fear, is the foundation of financial strength.